Welcome everybody to our Bay Area Housing Market Town Hall. I just want to remind everybody, go to our YouTube channel. You are already on YouTube, then please do subscribe. We consistently trying to put out a lot of videos. Today, this is our 36th episode already. So hopefully you guys can continue to support us and subscribe to our channel. If you want to follow us and really continue to get more updates about our company, do go to our Facebook page, or you can go to our Instagram, LinkedIn, and TikTok. And Daniel is our repeated guest on our webinar. You have so much knowledge and you do loans for a long time. Would you like to actually introduce yourself first? Let me stop share.
Yeah, so my name is Daniel Gat. I'm with Synergy One Lending. I've been a mortgage lender since 2005, so 17 years doing residential mortgages. And I've been working with you for at least 10 of those years, which has been phenomenal.
Yes, during the last recession, for sure.
Right. And this was a great explanation. I want to add that one definition of inflation that I heard is when there's more money than product. And it kind of lines up with what you were saying, that, you know, with supply chain issues and the government printing money, well, you have less product and more money. And so that is how we ended up in this inflationary period. And then there's other topics I won't get too in depth about, but if you ask Saudi Arabia, they'll say our prices of gas are high because we don't invest in refineries in the United States, and that if we did, we could be paying half as much. It's had nothing to do with the Russian war, but it depends on what who you want to believe, our media or the people selling us gas from the Middle East. But
exactly. I mean, if you talk to the German, it's a completely different story too. For them, their gasoline is really heavily reliant on the Russian oil. So right now, for them, in order for them to survive, they really, according to Gunnar Branson, he's saying that Germany now have to really invest into clean energy, and this is actually really towards the future of the world. Whether US is going to be going towards that direction as fast as the European countries. So we have to see, but it is definitely the direction that's going.
Yeah, Europe definitely has to make faster moves. I mean, they were heavily reliant, whereas we were getting about 10% of our oil from Russia. So for us, it really shouldn't. I mean, it depends on what we believe we're being told, but we believe that our gas prices are doubled or tripled because of the Russian war. If only 10% of our oil comes from there, that's hard for me to comprehend, but we won't get into conspiracy theories. Let's talk mortgages. Let's talk lending. And,
Sounds good. Well, I guess like one of the reasons why we brought you here is that obviously with the interest rate hike increasing so fast, every 2 weeks, we're just like, oh my gosh, increase again. A lot of buyers are feeling very, very uneasy. So how should they go about this? Are there steps that you can actually share where, they kind of ease their minds so they're not as worried?
Yeah. So, well, one thing to keep in mind is that no matter who you talk to, we all believe that eventually we're going to get out of this inflation, whether that's Q1 2023 or Q4 2023 or Q1 2024, it's inevitable that the Fed is going to take the proper steps to get us out of the inflationary market. And historically speaking, every time we've had inflation, interest rates have gone up. And every time we get out of inflation, interest rates come back down. So while it can be intimidating to look at what rates are today versus even 12 months ago, it's important to know that there will be opportunities to refinance, to have better rates in the future, and that this may be a time that is less competitive to buy because there's a lot of people that are maybe waiting for the rates to come down, but when they do, all those people are going to come back in the market, and that's going to shift housing prices back up. I think is when we see much more competition in the market. But it's really important that when you get pre-approved, to understand from your lender all these details. Like we talk in the lending world about debt to income ratios. So these are DTI ratios. It's a very important matrix. For example, jumbo lending, which is larger loans, typically what you'll see a lot of in California. Jumbo lenders typically say that you can have a maximum debt to income ratio of 43%.
Sorry, I'm going to stop you right there just in case we have people who don't understand what debt to income ratio is. Do you mind to go over real quick, how do you guys calculate the debt to income ratio?
Great question. Yeah. So debt to income ratio is going to be your proposed housing payment. So your mortgage, your property taxes, your insurance, and if there's an HOA, your HOA dues as well, plus any revolving debts that show on your credit report, meaning minimum payments on cars, minimum payments on car leases, car loans, credit cards, student loans, personal loans, any type of loan that's going to show up on your credit report. We add all those minimum payments to your proposed housing payment and do that as a comparison of your taxable income. So if you're W-2, taxable income is very simple. It's your gross income. If you're self-employed, it's a little bit more complex, but the easiest description would be, it'd be your income after your expenses that you write off on your taxes. So now understanding the debt to income ratio calculations, if you get pre-approved with a lender and the lender says, hey, you're good to go, I think it's really important to ask your lender, well, what's my debt to income ratio? And this is not something that I would have ever in the past said that a consumer needs to know this, but in this market we do. And the reason why is that if the lender says, well, you're at 42.9%, great. That means that you need to be really on the watch for where interest rates go. Because if interest rates go up by 1/8% next week, and you haven't yet locked in a rate, you haven't found a house and locked in a rate, you may not qualify anymore for the maximum that lender qualified you for. But if they tell you your debt to income ratio is 35% or 38%, you have a little bit of wiggle room that rates can go up and you can still be fine. And even if you don't want to try to figure this out on your own, another recommendation I would have is every time you see a place online or that your real estate agent shows you a place and says, hey, do you want to go check out this place? Before you go see the place, check in with your lender. Call your lender and say, hey, where are rates right now? Can I still afford this maximum number that we had discussed previously, or is that number shifted? So I think it's important to understand that a pre-approval is not a static document. It's a dynamic document. It's moving as interest rates move. So a lot of times I get asked, how long is the pre-approval good for? Now the answer is really, depends. From a banking standpoint, we would just say 90 days. But the reality is it depends on where the interest rates are and if anything's changed in your financial picture since the time that we verified your paperwork. In other words, if you lost your job or changed jobs, if you went out and bought a new car after you were pre-approved, these are all things that can impact what you're actually going to qualify for at the time that you're trying to buy a house.
So let me ask you this question then. For example, sometimes some people, they have an underwritten approval letter already because, we're so used to that. Oh my gosh, it's so competitive. You probably want to go in very strong. A lot of people have been making offer without the loan contingencies, and they had gotten an underwritten approval letter. But doesn't mean that now you can just make an offer with no loan contingency because the interest rate might have changed, right?
Right. That's why it's so important to check in with your lender and just to understand that what is an underwriting approval. There is no mortgage approval that is 100%, even an underwriting approval. An underwriting approval is a conditional approval. And what do I mean by conditional? Meaning that they can redact that approval if, let's say, 5 days before you're supposed to close on your purchase, you terminate your employment. The bank has no obligation to give you that loan that they underwrote you and approved you for. They'll say, no, based on 5 days prior to closing, we cannot deliver a loan to you anymore because you're not employed any longer. So,
and they check your credit report again.
They check your credit as well. So that's another thing. I joke with clients all the time. I say that, don't go out and buy a Lamborghini right after we underwrite you and then before you finish buying the house, because let's say you did and there's a $4,000 a month car payment. Well, now the bank has to include that in your debt to income ratios. And even if you were approved up until this is 5 days before closing, the bank finds out you bought this car. Now it shifts your debt to income ratios. You may not be approved anymore. So it's important to understand that it's always conditional until you get keys to the house. The minute that we fund the loan and it closes, then there's no conditions. If you quit your job, you change jobs, you buy the Lamborghini, you do whatever you want, the bank has no recourse. It's your house. It's a done deal. It's your loan. But until you have that loan funded and you have keys to the house, it is a moving target. So it's important to check in with your lender consistently. Where are rates so that even if you've been underwritten, that you can make sure, well, based on today's rates versus yesterday when I was underwritten, do I still qualify?
Right.
That's a good question to ask your lender.
Now, this is like not going out and buying something expensive is not because of the interest rate hikes. anytime you are applying for a mortgage, even though the interest rate was very low, you still should not be buying anything extravagant or expensive in the middle of escrow. So hold on to that desire to buy that car right now. We do remind our clients sometimes, like, hey, don't go out and buy all these furnitures or a car during this time. If you do have to get pre-approved again. But if you're in the middle of the transaction, then you have to be very careful about that. Now, with the current interest rate hikes, do you see that banks are becoming more stringent in terms of the guidelines? Not just the debt to income ratio, but I'm talking about like maybe increasing, we need more reserve to see that in their bank account, or they need more documentation?
Yeah, so that's a great question. What I have seen is that some of the traditional banks that were doing maybe 90% loan versus value, so they're lending 90% of the value of the house, some of them have cut back to 85%. So that's on one end where we see it, that banks are tightening up their guidelines a little bit. As far as reserves, I'm seeing that those guidelines I haven't really seen change from over the last few years. But I will say that, for example, agency loans, which are loans sold to Fannie Mae or Freddie Mac, Fannie Mae and Freddie Mac have something called AUS, which stands for Automated Underwriting System. Every bank in the United States can sell a loan to Fannie Mae or Freddie Mac up to the conforming loan limits. These AUS systems, which are called DU and LP, depending if it's Fannie Mae or Freddie Mac, they generally have, as long as I've been doing this, if somebody has decent credit scores, I've seen these systems approve people to somewhere around a 50% debt to income ratio is what the maximum these automated underwriting systems will allow. I've noticed in the last few months that the systems are not as easily approving people to these higher ratios. So I believe that Fannie Mae and Freddie Mac may have changed their algorithms in these automated underwriting systems that the banks use. And it's possible that they've made them more stringent. And I recently had a client that I couldn't get approved at above 36% debt to income ratio with the automated underwriting system. And it turned out we had to use a different type of loan, a FHA loan, which is Federal Housing Administration, which did allow for her to be at a higher ratio in order for us to find a solution for that client. So I think it's important that you're working with a lender that looks at all your paperwork, runs the AUS system, sends your loan into underwriting, does all of these steps so that by the time you make an offer and you go through all that effort, you know that you're going to make it to the finish line without any bumps in the road from the lending side.
That is actually a really great point, is that especially right now, because the market fluctuates so much, you really cannot just go in like, oh, okay, let me just walk into any bank and then talk to a loan officer. You have to work with somebody. Even I'm talking about like if somebody wants to walk into that bank, you have to work with somebody who know what they're doing, who maybe can ask for exception. And for example, Daniel, you've been in the industry for 17 years, right? You said,
Yep.
Which is actually the same as me, 17 years. And you have so many connections with so many banks out there. So you're a mortgage broker and also a correspondent lender, or are you direct lender?
Direct lender, mortgage broker, and I have friends that work at most of the banks out there. So I feel like I'm a one-stop shop with all the connections.
Yes. So you can actually figure out, okay, with this scenario with this client, if this bank doesn't work or this guideline doesn't work, I can change it to another one. And or maybe you can actually talk to underwriting department and then get certain kinks out of this file. I think it is really important, because if the loan officer does not know how to work with the underwriting department, the failing rate is high and you can lose your earnest money deposit.
Yeah, and I will say in the 17 years I've done this, I've never had a deal fall apart because of a lending issue. Certainly we've had to make shifts every once in a while, every once in a blue moon, make a quick shift to a different product. But we've never failed because we do our due diligence up front. And my team and I have a knowledge base, 17 years of doing this and being a top producer. We never guess on anything. If we're not sure, we go to underwriting. We want to be 100% sure. We want to make sure that if we say you're good to go, you're going to get keys to that house.
Yes, and again, different banks have different guidelines. This is one of the reasons why people come to you, because you work with how many banks would you say?
Right now, over 20.
Over 20.
Yeah, quite a few.
Yeah. So you work with over 20 banks. So if you, and then each bank have different guidelines. So you're going to fit each person into a different bucket to make sure that they can get qualified. And then your job is to go over all the paperwork first. So I'm trying to kind of also explain how agent realtors work with loan officer. As a buyer's agent, I always work with a loan officer to make sure that, well, have you, that's my first question too. It's like, have you looked at their debt to income ratio? What is it? I want to know the loan officer knows. And believe it or not, I have talked to loan officers and they could not give me that number. And they were like, don't worry about it. Everything looks good. I was like, well, what is the debt to income ratio? And if they cannot tell me, then I don't feel confident to let my clients know that, yeah, I think your loan is going to go through. I mean, I can't even say that, but I need the loan officer to give me that confidence. And that's really important too, because when you make an offer, your loan officers need to be very responsive, because listing agent can also ask that same question. Have you, have you really looked at all the files? Did you run their credit report? What is their FICO score? They may not, I don't think you guys can tell the agent what is their FICO score, but they want to hear that what, how well qualified they are. They need to instill that confidence in the listing agent.
Absolutely. And I think that, in general, this is one of the advantages of being in my position. Our job is called a mortgage banker, where we don't work at a bank, but we are a direct lender and we also broker loans. 100% of my business is referred by real estate agents. So if I fail at what I do, I also expect that I'm not going to get referrals. Whereas somebody is sitting, and this may vary obviously from person to person. I'm not trying to single out everybody who is at a big bank, but if you sit at a big bank behind a desk and everybody that walks in the door is an instant client of yours, you don't have that same responsibility that your referral source is going to disappear because your referral source is the bank you're sitting behind a desk in. So I like to think that, while there are loan officers, and there's ones that are in my position too, that are mortgage bankers, that maybe guess or, get half the paperwork from their client and say, yeah, you're good to go. Those of us that want to maintain a perfect record, and I have a Zillow page with 100% 5-star reviews. If you want to maintain that, you have to be 100% right. You can't be wrong ever. And you have to deliver. And it's so important because the person I'm working with, they're making the biggest financial decision of their life to buy a home. And I can't imagine, after all the stress of looking at multiple houses and making offers and then finally getting an acceptance, I can't even imagine the stress that somebody would go through if at that point, then they found out that their pre-approval wasn't worth anything and that they can't close on the house because they don't actually qualify. So I think it's really, really important to if you're interviewing multiple lenders, which I think most buyers do, is really get a feel for what is that lender's knowledge base. Look up information on the internet, quiz them, and see how well they can respond, because it's not only about the lowest rate, because the lowest rate with somebody who can't deliver a closing doesn't necessarily help you in any way. So I think it's more important to say a great rate and somebody who really understands what they're doing and can deliver great service is the best place to go.
Absolutely. And I do want to go over a little bit about the steps, how to actually get this pre-approval process, just in case somebody have never done it before. But before we go there, I also want to mention and emphasize how important it is not to just go onto any of these online lenders. These online lenders, they might be good to do refinancing, but when you're doing purchase, it's very time sensitive. And if you have promised the seller that you're going to close within 30 days, you better be able to close within 30 days. If somehow you cannot, you are begging for extension from the seller. And if the seller somehow got a better offer than yours, he can easily just say, no, I'm not going to grant that extension. You need to get out. I'll take your earnest money deposit and I'm going with a higher offer. I'm not saying it happens a lot, but just in case it happens, then you just don't want to go with any online lenders, because they typically they're not as responsive and they don't understand the speed of our market as well.
Absolutely. I think that's so important is that you have somebody who has local knowledge and a great reputation and is, not just somebody who came into this industry in the last 2 years because they heard it's easy to make a living in it, which it was in the last couple of years, but not anymore. The good thing is this market's, we're seeing a lot of people that were fly by night lenders leave. And those of us that do this as a career, we're happy to see them leave. But it's important that you have great representation, both with your real estate agent and with your lender if you want to be successful.
Well, sorry, just because you brought that up, if people always think that real estate is so easy, but they have no idea until they're in it, right? And then realize that there's so much more work to do behind the scene. So anyhow, I just thought to throw it in because you brought that up, that people always think, oh, it's such an easy job. You guys make money so easily. I'm like, oh, you have no idea. It's like the most stress, well, not the most, but it's really truly stressful. And I don't know how many times I've seen that happening when people coming into the industry and then just, stress out. But anyhow, so go back to the steps. Like, what are the steps that they need to take from filling out an application first or talking to a loan officer? How does that process look like?
Yeah, so I think the best way to handle it is a conversation first. So like when I'm introduced to a new client, I'll usually try to set up a phone call with them and I try to understand their needs, kind of any background story that needs to be told. And then I'll generally ask the new client if they have time for a little Q&A where I could try to figure out over the phone a ballpark of what they qualify for. And if the ballpark numbers look like, hey, this is in the right range for what you want to do, then we can shift to the next step of putting together paperwork. So I'll start with a Q&A, and then if all the numbers look good with the Q&A, I'll generally send my clients a link to a secure site where they can fill out an application, and I'll ask them for all the appropriate documentation, which can vary from tax returns, W-2s, paycheck stubs, bank statements, if they own other real estate, mortgage bills, property tax bills, insurance bills. Every detail of your financial life is basically being asked for. And if you're working with a lender that doesn't ask you for all this paperwork, they just say, well, tell me what you make and let me run your credit. Let me tell you already, that's a terrible idea to trust that that's a pre-approval. That's not enough information. It's not enough detail. And when you're buying the house, the underwriter's not going to just ask you to tell them what you make. They're going to ask for the documentation. So make sure that if you're working with a lender that they ask you for all these kind of documents, which is truly not a fun process to put it all together, but it is what is necessary to ensure that when somebody tells you you're pre-approved, that they are telling you that based on the same documentation the underwriters are going to see. And furthermore, these days, as Helen pointed out, a lot of people want to get underwritten. You want to get an underwriting approval. So generally speaking, the process is pre-approval, which is myself or another loan officer doing the review of your paperwork and saying what we believe to our best knowledge you'll qualify for. And then we need to turn everything into the underwriters, and they're going to either confirm that we did our numbers correctly, or they'll confirm that we didn't, and that these are the correct numbers that we should be using. But ultimately, to do an underwriting approval, you'll need all this paperwork. So it's really important that I've had people that are hesitant about putting together the paperwork just because it's a little bit of pain in the rear to get it all together. But it's ultimately for your protection. It's not because I want to hassle you for the paperwork. It's because I want to make sure that whatever I tell you is 100% accurate and that you can go make offers based on my information that I'm providing you, that you can secure the lending for at the end of the day.
That is the biggest complaint we hear from our clients about the paperwork. But like you were saying, the paperwork is absolutely necessary in order, but there are ways to reduce some of the paperwork, especially if they have a lot of in and out of deposits and withdrawal, or if they have some other gift money coming from outside of the country. Because if you have some gift money from outside the country, then there's going to be another layer of documentation you will have to provide, correct?
Correct. Yeah, it's there's every file is different, right? As far as what paperwork is needed. But if you have gift funds, it's one thing to have gift funds coming domestically. It's another thing if they're coming internationally. And it's another thing depending on the bank's guidelines. Some banks have a guideline that say if the gift funds are wired directly into the title company, then all we need is a gift letter form and a
Mm.
copy from the title company of the wire receipt showing that it matches the name of the person who said they're sending the money. Other banks have guidelines that say, no, we want to see the transfer of the money coming out of the donor's account. And if they're in an international account, maybe they also want to have that translated by a certified translation company.
Mm.
So there's all these multiple layers. So really, the earlier you can start the conversation with your lender, as soon as you have that inkling, I might want to buy a house. That's the exact moment you should start talking to a lender, because it's not when, hey, I just found a house or I've been looking at houses for the last 3 weeks, because there may be some obstacle or something that we find out in the pre-approval or underwriting process that might have some time constraints for you to
Yes.
sort through. And so the earlier you can start that process, really the better off you're going to be. And the easier it's going to be once you find a home and have an accepted offer to get through the formal process.
I cannot agree with you more, because honestly, lender and us, we are partners in a transaction, right? And sometimes our clients would say like, hey, I don't need to get pre-approval. It only lasts 3 months. So I want to find a house first before we go to talk to a lender, or they have already talked to a lender. They just don't want to get a pre-approval yet. And from what they think is that pre-approval is only going to take 2 days anyways, but it's a lot more than that. It really, you need to take looking at all the paperwork or even submitting into underwriting can take a week, 2 weeks sometimes. So just be prepared, because in case your file is not as clean and straightforward, at least you're prepared ahead of time how to handle it. Some of our clients, for example, like we said, have a lot of in and out of the money from international or within domestically. Maybe you need to have the money seasoned first for 3 months before you start the process. There are things that you do need to be aware of before you really make that decision to purchase a property, because you need to understand the timeline.
Absolutely. And that's why, and this 3-month thing with the pre-approval, the reality is that as long as nothing about your finances change, meaning your job and employment's the same, your liabilities are the same. You didn't go out and buy that nice car before you bought the house. And so your liabilities and income, and then your assets too, as long as nothing negatively is impacted, right? If your income goes up, great. If your assets go up, great. If your liabilities go down, great. There's no reason for you to believe that in 6 months or 12 months after you've been pre-approved, that the numbers won't be the same. And generally speaking, for my clients, I usually will tell them that I will write pre-approval letters for them for up to 12 months after I pre-approved them, with the understanding that if they have an accepted offer, we'll have to pull a new credit report and update the paperwork. But that we have to have an understanding that I'll do that for 12 months as long as we have an understanding that there's no changes to any of those, negative changes to liabilities, income, or
Credit
assets.
score.
And the reason I do that is because there's no reason that what you qualify for today won't be the same in 12 months if nothing's changed.
Yeah, unless for some reason, your credit score, because you had gone up to have so many inquiries on your credit report, and then your credit score dropped below certain threshold, and that can affect your interest rate even that you can qualify for.
Right. So I think it really depends. Like the client that has a 38% debt to income ratio and a 800 credit score, I'm not so concerned. If their credit score goes down 20, 40, 50 points, and they're still going to be fine, and interest rates go up by 1%, that person's still going to be fine. The person who's on the ragged edge, again, I'll give them the same advice we talked about earlier, which is check in with me every time you're interested in seeing a house. Check where the rates are. Let's make sure that the numbers still work. I generally provide all my clients with an Excel spreadsheet that I created that they can.
Oh, I've seen those Excel spreadsheets.
Yes.
Very detailed.
Yeah, and I think it's so important, right? Because then the client I'm working with can see what their own debt to income ratio is. All they have to ask me is what's the rate. They plug it into the spreadsheet. They plug in the purchase price, the down payment. If there's HOA dues, they plug in a few parameters, and it'll tell them what their debt to income ratio is. And it'll even say on the spreadsheet what the maximum is allowed to be for their particular scenario. So I try to find tools and ways to make it easier for my clients to understand, on a day by day or week by week basis, with all these rate changes happening, how does it affect their ability to qualify? And more importantly for them, even probably, how does it affect their monthly payments?
So after they get the pre-approval from you and then they make an offer, they got it accepted, what happens after that?
So as soon as that happens, my team reaches out to the title company. We get all the appropriate paperwork from the title company. We order the appraisal day one just to make sure that we're moving all the pieces of the puzzle forward very quickly. And then we'll reach out to our client, go over the latest terms. Now that your offer has been accepted, we can lock in the rate, which is a term we use for saying you can secure this rate all the way through closing, regardless of what the market movements do between now and your closing. If you lock in the terms of this rate, we will deliver on those terms at the closing. So we provide our clients with all the different rate options with paying points, not paying points, and points are an additional fee you can pay a bank to get a lower interest rate than the market rate they're offering. So we try to give all the different options to our clients. And then also we go over their file and say, okay, we underwrote you 2 months ago. Well, we need to update paycheck stubs, update bank statements. We need to update a few other things. And we advise our clients of what they need to start doing too, like start shopping for an insurance policy for your home to insure your home. And when you make your earnest money deposit to the title company, let us know when it clears your bank account. We'll need to have a transaction history showing it clearing your account to give to underwriting. So there are certain, we kind of give direction as to what are the next steps. And we try to be patient too, because we understand that on your end, the real estate side, you have a ton of paperwork for your client as well. And the escrow and title companies are going to have a ton of paperwork too. So there's a heavy process when you first get your offer accepted, because everybody's coming at you for paperwork. But you know, it's not really that bad. You can get through it in a matter of a couple of days, and then you have a kind of quiet period while you go through underwriting, wait for the appraisal to come back, and we try to make the process as smooth as possible, make ourselves available as much as possible, so that you know, when somebody's going through this, what could be a stressful process, we want to make it feel like, well, at least I've had the answers to every question I have. So how stressed can I be if I know everything and it's available to me? And that's why we love partnering with you too. We know that your clients are very well informed from the great work that you do in your team, and we try to match the same thing on our end with the lending support.
Yeah. Exactly. I mean, that's why it's so important to find a really good loan officer partner. And because like you said, the first couple of days, or we kind of give our clients the first 5 days, like, hey, you're going to be focusing on the loan process, the loan paperwork. We're going to have our paperwork, but we try to give it to them after, so that they can really focus on one thing at a time. I'm one of those people, I cannot be like, if you just give me everything, I get so overwhelmed. So I like to tend to do that for our clients, to like, here go, focus on the loan first. And then after 5 days, that settled down, we're going to give you other stuff to do. And then the escrow company, we kind of try to pace it for our client. Now, why do banks need appraisal? Just in case somebody asked that question.
Yeah, great. That's a great question. So the banks, you know, want to understand. Banks lend on what they call LTV, which is loan to value, and value to the bank is the lesser of the purchase price or what a third-party appraiser appraises the property at. So in many cases, they're the same number, and that may seem strange. Why is it that a random offer would always be the appraised value? You know, this can get into conspiracies, but long story short is appraisers have a copy of your purchase contract. My personal opinion is that a big part of their job is to justify, based on comparable sales, is the price you're paying a justified price? If it's not, if comparable sales are all like $100,000 below, they're not going to just arbitrarily say that the price you're paying is the appraised value. If it's plus or minus, like, you know, 10, 15,000, they probably will come in right at the price that you're paying. If some of the comps are slightly more, some are slightly less, it makes sense. And again, if all the comps are $100,000 more, then and by when I say comps, I mean comparable sales that are recently sold in the same neighborhood, usually within a 90-day period. And in a market where we have a lot of movement like this, the appraisers are really trying to say, well, let's use comparable sales that are as recent as possible, because 90 days ago could have been a very different market than today even. But the bank wants to know that an independent third party believes or what value they believe the property to be. And then they'll lend you, you know, if you were doing 20% down, for example, then it's an 80% loan versus value, or loan to value, LTV. So the bank will say, okay, we want to make sure it appraises, and whatever price it appraises for will still, the lesser of the appraised value or the purchase price, we will lend 80% to that. So it's important for the bank to understand that, you know, it's the bank's way of knowing that, are you getting a market price for your house, or are you overpaying or underpaying? They're happy if you're underpaying.
Yeah, absolutely. And have you seen like for the same property, a couple of different appraisers, they come back with a very different number?
Yeah, so the first time I saw this was over a decade ago, and I was doing a loan for a friend who lived in an affluent area, and we had two appraisals done. They came in, one was like 2.3 million and one was 2.7 million for the same house, done on the same week. Um, what I learned then was that there's not necessarily consistency between appraisers. So it's important to understand that if your appraisal comes in low, for example, while that may affect your lending ability, what the bank's willing to lend to you, it doesn't necessarily assure you that the value is low. It could be just an appraiser. An appraisal is that appraiser's opinion of value. There's more than one opinion, though, and out there. And I truly think that if you hire 10 appraisers, you probably will come up with 3 or 4 values for the same house.
Absolutely.
And that's just because it is an opinion of value. So we tend to work with AMCs, which is appraisal management companies, that hire local appraisers that have local knowledge. So we don't want an appraiser from San Francisco coming into San Jose. And same thing, we don't want somebody from San Jose maybe going to Berkeley. We want to have somebody who's a Berkeley appraiser that knows that area the best to do the Berkeley appraisal. We want a San Jose appraiser to, specific to Central or Northern San Jose, to the specific neighborhood. We want somebody that's really, really well trained so that we avoid these kind of issues where maybe we have a low value because somebody doesn't understand the nuances of, well, if you cross this particular street, values of homes go down 20%, but if you're on this side, they're 20% more. We want somebody that has that kind of local knowledge.
Yeah, and to give an example, years ago, I had an instance where two appraiser appraising the same property, and this property is only 1 block from Main Street, and this property is an investment property, and one appraiser actually said, "Oh, this is great location. It's only 1 block from the Main Street. Awesome." Gave it like extra value for that. The second appraiser said like, "That is not good." And that's his opinion. He's like, it's not good to be 1 block from the Main Street. That's the difference between appraisers, that they are so subjective. It is, like you said, is their own opinion of value. And they can see something that one person think that this whatever remodeling is great, and the other person would think that this remodeling is just it's not that great. So um unfortunately, it does happen sometimes. Appraiser don't appraise the property at value, but just understand that if you have, like you said, 10 of them, I think we're gonna have like all 10 different values, or maybe at least 7 different values.
It's very possible. That's what I've experienced over time, and it's an opinion of value, and we hope that we get, we this is why we choose to work with, we choose the appraisal management company we work with. This is all to do with regulations that were put in place in 2009. Prior to that, a mortgage lender would just call an appraiser that they already have in a relationship with and ask that appraiser to go out and see the property. Now, banks and mortgage lenders order appraisals through AMCs, which are third parties, and they randomly select the appraiser from their panel of approved appraisers to go out and do the job. And the reason for that is to make sure that there's no influence from the mortgage lender to the appraiser, so that there's no funny business and that you're getting a fair assessment of the property.
After the underwriting, they receive the appraisal report. If the appraisal value is good, then they move towards the loan approval. There's this thing called closing disclosure. How does that work? The timeline and all the way when they need to put in their down payment and closing.
Yeah, so the closing disclosure is when the bank is essentially, I'll back it up a little bit first. First is a loan estimate, which is something that as soon as you have an accepted offer, within 3 days, the bank is required to provide you a loan estimate, which is an estimate of your closing costs. I'm going to say this as bluntly as I can, which is most of the time these loan estimates are going to be completely wrong. And the reason for that is that the bank is not choosing the title company. The bank's not choosing the escrow company. We don't know how much the prorated property taxes are, the transfer taxes, and other costs that are not associated with our bank. So we have a system that will input these numbers that are automatically generated, but they're not necessarily the numbers that are associated with your transaction. So what we do is we send out this loan estimate. We advise our clients that they're not binding. It doesn't require you to accept these terms, that you signing these initial disclosures are simply you acknowledging receipt. Then we send this loan estimate that we had you sign and acknowledge receipt of to the escrow officer. And we ask the escrow officer to put together a buyer's estimated closing statement. And that way we're starting to get actual firm numbers of what your closing costs are going to look like. By the way, generally I'll ballpark what I think it's going to be before, long before we even got an accepted offer. And generally these numbers are going to be well within the means of what I ballpark, but we'll get an estimate now that is far more accurate. And then ultimately, the bank needs to send out this CD, this closing disclosure. And that closing disclosure should be more matched up with the actual estimate from the title and escrow company. It should be more accurate numbers. It should be really delivering numbers that you're going to be actually expected to deliver at closing as far as cash to close. What are each of the separate fees? This is the final version of any type of estimate. And I still say estimate because until you're closed, that's when you get a final closing disclosure. And the reason
because if you close one day late or one day earlier,
yes,
that can change because of property tax proration or interest proration.
That's exactly it. That's why it's still called an estimate all the way up to the end. But from a timing perspective, which was the original question, once the closing disclosure is electronically signed, the soonest you're allowed to sign closing documents, and this is really pertaining to primary residence and second home. This doesn't pertain to investment property. There's no waiting period on investment property.
That's
but
right.
For primary residence and second home, there's a 3-day waiting period. So once you've e-signed that closing disclosure, you cannot sign the actual closing documents, the ones that you're going to sit down with a notary and sign, and these are the official binding documents. Those can't be signed until 3 days later. They don't count Sunday as one day, and they don't count holidays, but Monday through Saturday are counted as calendar days that for the 3 days. And it's important to know that because when the lender sends you a closing disclosure, you don't want to just leave it in your inbox for a week because it's prohibiting the lender from being able to get to the next step of actually issuing the closing documents, which are truly your binding documents. That those are the documents you want to make sure that everything's right. If you find a mistake, if your lender tells you sign it, don't worry, we'll fix it. No, don't do that. Not on the final closing documents. Everything needs to be right. If there's anything wrong, the lender needs to redraw the documents because these are final and binding. But so that's the process essentially. It's you have an accepted offer. We order appraisal. We clean up our paperwork. We resubmit your loan to underwriting, even though you may have already been underwritten and approved. Now it has to go back to underwriting now with a copy of the purchase contract, with the appraisal, these other items that need to be signed off. We get everything signed off. Once it's all signed off, we get issued what's called a CTC, which stands for clear to close. So underwriting's telling us, hey, you're cleared to close. And going back to something we talked about earlier is that even when you're cleared to close, it doesn't mean it's 100% done, right? If you leave your job that next day, then you're not cleared to close anymore. So it's so important to not change anything about your financial picture while buying a house. But we'll get the CTC. That the closing disclosure may go out before the CTC is even issued. That can happen much earlier in the process nowadays. So it can happen halfway through your escrow period. And then once we have CTC, that's when the bank can draw up the final closing documents. We'll send them to the title and escrow company. The escrow officer will set up a signing appointment either with themselves as the notary, or they'll hire a third-party traveling notary. And then you'll sign the documents. The documents go back to the escrow and title company. Then they go back to us as the lender electronically. And then we advise you when to wire your money to the escrow company, the remainder of your down payment and your closing costs, which is going to be about 3 days prior to closing. And then generally speaking, depending on the county, we may fund the loan 1 day prior to your scheduled close date, which means that we put the bank's money in escrow. And then the next day, the title company will record and close. And that's when you officially are the homeowner and get keys. And so we walk you through that whole process. We make sure that, we're all about, at least our process is about hand-holding. It's really just letting you know what to do and when to do it. So you don't have to sit there wondering, am I supposed to be doing something?
Yeah. And it sounds complicated, but trust me, a lot of these things is happening behind the scene. There are a lot of paperwork we do ask you guys to submit to the loan officers upfront. That's why get your pre-approval ready earlier, then you really have a preparation of all these paperwork ahead of time, because you don't want to wait a few days before you can submit your documents after your offer has been accepted. But then there are a lot of things on the back end that's happening with like the underwriting department, the escrow company, and then we try to like work with the escrow company and the lender to provide all additional documents, all that stuff. And we try not to stress our clients more, so they don't really see like, oh, nothing's going on. But trust me, a lot of things are going on the back end.
Absolutely.
Yeah, but thank you so much, Daniel. This is like so informative. We're going back to basic, but we do know that there are a lot of people do want to know, like, how do you get pre-approval right now? I know there are a lot of interest rate hikes, but essentially the process is still the same. You just have to be sure before you write an offer, do a pre-approval again with your loan officer, double checking your numbers to make sure that your debt to income ratio did not go past that maximum allowable debt to income ratio. But if you have any questions, obviously, feel free to contact Daniel Gat. We will have his contact information in the description below. Thank you again for tuning in, and then don't forget to subscribe to our channel. If you have any real estate purchasing information or other information about home buying, please do contact us. Bye-bye.